This is FRM Part 1, Book 3, Financial Markets and Products, Chapter 2, Insurance Companies and Pension Plans. And the chapter ought to be called, we're going to spend most of our time talking about insurance, and we'll just wait until we get to the end to talk about pension plans. So there's just one learning objective on the pensions. But in terms of an introduction, let me just remind you about this contract called insurance. It's really kind of fascinating when you think about it, because insurance is something that I guess we need, I guess we want, I guess we benefit from it, but we don't ever really want to use it. And so that brings some interesting aspects to it. Of course, nobody ever wants to get sick. We don't want to wreck our car. We don't want anything to happen to our homes. And clearly, we don't want to die. So let's look at how those factors play into the learning objectives. Notice we're going to use lots of command words, describe and define. We do have a couple of calculates in there and distinguish it. So we're going to describe key features of various categories of insurance companies. We're going to describe mortality tables. We're going to calculate premium payment and then a couple of ratios. We're going to discuss moral hazard and adverse selection. And these things are really important in terms of risk management as it applies to lots and lots of different types of contracts. We'll distinguish between mortality and longevity risks. We'll talk about capital requirements, some regulatory requirements, and then we'll get to the pensions at the end. Let's go ahead and start with categories of insurance. Here's a definition. An insurance contract is an agreement between an insurer and a policyholder where the latter receives protection in exchange for premiums. And when I see a definition like that, I'm always reminded of my father. When he was alive, he used to get so upset at his car insurance agent because my father died as an 83-year-old man who never had a wreck. So he would have this conversation with his auto insurance guy, and he would say to this guy, "You're making so much money off of me. It's not fair. And I would have to explain to my dad, well, look, Dad, you could always go out and wreck and get some money, but it's probably not going to be what you want. Anyway, we also had those conversations about life insurance as well. And he was always very proud to have life insurance so that my sister and I could benefit once he was gone. And so I guess that worked out for him. Who knows? We have two types of insurance. We have property insurance and then life assurance. And let's use the term assurance because it's really hard to put a price tag or a value on human life. So we'll just replace insurance with assurance. All right, how about types of life assurance? I currently have a 20-year term life policy in which I make payments once a year, and I am covered for the entire 20-year period, as long as I make those payments every year. Now, I did this when my 14-year-old boys were born because I figured having twins I ought to have something out there. And so I think I have 7 or 8 more years of that. Actually, when they graduate from college, I think is when that 20 years expires. Now, of course, let me get back there. If I happen to die before that 20-year period is up, then my wife will receive the benefit. But if I die after that 20-year period is over, then nobody gets anything with the terms of that particular contract. And of course, this is what my father was talking about when he was alive. All right, now the term, let me go back here again. The term contract is really exactly what it says. It's for a term, and you agree to make payments, and then the insurance company agrees to make payments to you or your beneficiaries if you die. And that's really a simple contract. And of course, insurance companies and financial institutions in general, they're out there to try to provide products that other people might be interested in that are not exactly like the term policy. So this brings in the specter of whole life. Under a whole life contract, the death benefit is payable when the policyholder dies, regardless of when that happens. So I could have a whole life insurance policy, which I do not have one of those things, but I could have one of those and I could die tomorrow or I could die 100 years from now, and the death benefit will be paid. Now, of course, there are variations of the whole life policy. One is called a variable life assurance policy, and this has an investment component. And so the simplest way to do this is just take one example and just chop it in half. Let's suppose we have a policy where the annual premium is $10,000, and the contract could be designed in such a way that half of that goes towards the death benefit and the other half goes to some type of an investment, like a share of stock or a bond or anything that you really want it to. And so the total benefit received on the death depends on the death benefit plus any gains or losses inside of that investment account. And of course, financial institutions are clever when they arrange these things. I mean, it doesn't have to be 5,000 this way and 5,000 that way. It could be any kind of a variation as long, of course, the insurance company is going to make certain that enough of it goes to the death benefit. And so think about it this way, that these whole life policies and their variations, they're really composed of two parts. The term insurance part and then the investment part. And then the difference between and among all these different types is what happens with those investments. So here's a universal life policy, which has lots and lots of flexibility. So my mother had one of these while she was alive. And so she could, if she wanted to, she could increase her premiums or she could decrease her premiums depending on her state of life or her financial situation. What happens with universal life is that the death benefit has some kind of a minimum level. Now you can also get some life assurance that says something like, look, if you die within 10 years, we'll go ahead and pay the death benefit, but at the end of 10 years, we'll go ahead and pay the benefit anyway. And there are lots of different choices for these kind of endowment life assurance policies. And then, of course, finally, there's a group life assurance. This covers multiple persons. This is usually employees of a company. And so I have part of this as part of my part of the college where I teach. You know, we're all insured based on some factor of our salary, and then we can add to it, which I do. Now, another service that financial institutions and life insurances provide is this concept of payment of an annuity. And so I want you to think of times during your life when you may receive some big lump sum. I mean, the obvious notions are, boy, if you ever hit the lottery, or last week, if you hit the superfecta in the Kentucky Derby, which paid $52,000 or something like that. Or when you get an inheritance. And this is what my father did when my mother died. He allowed the insurance company just to keep the money, and then they agreed to pay him a regular series of payments. So that's what an annuity is. It's the definition is a series of consecutive equal payments, and sometimes they're equal and sometimes they don't have to be, but they're probably going to last the rest of the policyholder's life. They can start immediately or they can be deferred. And what the insurance company does is they take that lump sum and they invest it in, pretty much whatever they want, although they're probably going to try to keep it to something like a secured bond or a mutual fund. And there are some tax deferments that are available for this. Yeah, let's go ahead and pretend that we're interested in dying. Let's talk about mortality tables. Remember, there's a group of people, and many of you are working in this field, actuaries, who figure out these mortality tables, which gives probabilities of dates of death. Now, remember that what the actuaries are not doing is looking at me and saying, hey, you know what, Jim, you're going to die in 12 years and 4 months. But what they're going to say is they're going to say, hey, look, there are tens of thousands of men that look like you that are 57 years old, that have about the same weight, have about the same hair loss, have 4 children, have this amount of money. They collect all this information. And on average, you guys are going to die, what did I say, 12 years and 3 months from now. Now, of course, we have to separate this for males and females because for some reason, those two groups of people don't seem to live as long as the other one. Now, the end result here is that these mortality tables are used to price the insurance contracts and to kind of predict those future insured events. One of my close friends is a very, very successful insurance guy. And, he tells me lots of stories over the years, but his most favorite story is insuring a hole-in-one at, some kind of fundraising golf tournament. And he says that he stopped doing that because one of the first times he ever did it, he gave some low price, some regular price. And apparently the first person on the first hole had a hole-in-one. So anyway, so we're using not mortality tables for hole-in-ones, but you can do mortality tables for almost anything to illustrate that kind of an example. So here's a table. Going down the left-hand column, we have ages. We start with birth, and here we stop at 35. Probability of death within 1 year, and then number of lives. We begin at 100,000 births, live births, and then after 35 years, we're left with only, about 96,500 of them. And so there's life expectancy and remaining life expectancy for males and for females. Let's go ahead and interpret this table. Let's do row 3 here. The second column gives the probability of a male aged exactly 3 dying within the following year. So from 3 until the 4th birthday, and that's 0.00023. The third column gives the number of male lives out of a beginning of 100,000 that will attain the age of 3. So 99,289. And then the fourth column shows that a male age 3 has a remaining life expectancy of 73.69, plus those 3 years gets back to the 76.69. And the females can be interpreted in the same manner. So let's go ahead and work through a calculation example. So you might want to get your calculators out here, but the math is relatively easy, and it's some good algebra. We buy a 2-year term contract for $100,000, 6% annual interest rate, but it's semi-annual compounding, so we're going to have to cut that in half. That's why when we do the math over the next couple of slides, you'll see 3% in there. So that's 3% as a semi-annual interest rate. Premiums are paid annually in advance, of course. And the question is, what is the break-even premium? All right, so what did we say? I think I didn't mention this. Robert is 30 years old. So let's look at that 30-year-old row. What we're going to do is we're going to equate, in order to compute this break-even, like you do in lots and lots of financial break-evens, you have an equation, and you have something on the left-hand side, something on the right-hand side, and you set them equal to each other, and then you solve for the variable. And so what we're going to do is just make the simplifying assumption that we did back in our original introductory finance class long time ago when we were 18 or 19 years old. We're just going to say that the present value of the income has to be equal to the present value of the outgoing. So you have stuff coming in, you got stuff going out, you set them equal and then solve for the premium. And that's really what we're going to do. So let's start with the left side of the equation, present value of the income. Let's allow the variable X, uppercase X, to be the annual premium. And so we're going to pay that immediately. So the present value of that is X, right? Because we're paying it today. So that's X. Plus we're going to pay something a year from now if we live that long, right? So how much are we going to pay during that second year? Well, that amount is going to be X times some probability, so to speak. And that's, if you look in the formula at the bottom, that's 99.8374X. So the first X is 100% of X because we're paying it now. The second X is 99.83 something of X because some of us are going to die between age 30 and age 31. Now, of course, the question then becomes, how do we get that 99, 83, 74? Well, let's go up to the table and we see that row of the exact age 30 probability of death within 1 year, 001626. Let's subtract that from 1, and that's going to give us the 99, 83, 74. All right, so think about what we're doing. We're paying X today. Let's say it's $1, and then a year from now, we're paying 99.8374 cents, right? So those are the two premiums summed, and then we got to take the present value of the second one, and we're going to do that at, remember I told you this just a second ago, 6% annual rate, so we're going to cut that in half, and we're going to raise it to the to the second power. So it was 1.03 raised to the second power. And so if you do the division and the adding, you get 1.94106 X. That's the present value of the income. So that's the amount that the insurance company expects to get today in present value terms. Now, what happens on the other side of the equal sign? The expected payout if Roper dies in the first year is 162.60. So we take that 0.001626, multiply it by the death benefit of 100,000. So that's a pretty easy part of the math. And then the second part, if he dies in the second year, what's that number up there? 0.001669. We need to subtract that from 1. Multiply it by that 100,000, and then we need to discount these back to time period 0. Now, one of the interesting best practices in terms of making these calculations in the insurance industry is to make the assumption that the death occurs midway through the year, and then the benefit is going to be payable immediately on that death. All right, so let's do the present value of the outgoing. So we've got the 162.6, which we just calculated, divided by 1.03. That's for 6 months, right? That's raised to the 1 power. And then the 166.63, where does that come? That comes from the second block point there, 166.63. And we're going to take the present value of that by dividing 1 plus the semi-annual interest rate. We're still at 3%, and doing it for 18 months. So that's 3 periods. And so we get 310.35. So notice what we're doing there. Present value of the ins equals the present value of the outs. So we've got the 194 is equal to the 310. Break even premium 159.90. How about some ratios in property and casualty insurance? So let's take a look at the loss ratio, which is the payouts made to premiums earned during the course of the year. So think about what that means. Payouts made, suppose that's 10, and premiums earned, suppose that's 1. Well, that's not a very good ratio. How about payouts made 10, premiums earned 100 or 1,000? Well, that's good. So what do I have there in that first circle point? A high loss ratio indicates poor financial health for the insurance company, so they might not be collecting enough premiums to pay the claims or their expenses to make a profit. Now, the expense ratio is the ratio of expenses, which includes things like advertising fees and wages for the employees and any kind of commissions and any other stuff that you can throw in there for expenses. And so this expense ratio, just like it kind of tells us when we look at the expense ratio for mutual funds, it tells us how efficient the insurer is in terms of cash management. Now, if we combine the loss ratio and the expense ratio, we get the combined ratio. How's that for a clever terminology? And then the operating ratio is defined as the combined ratio after dividends less any investment income. Let's go ahead and look at an example. Let's suppose that we have a loss ratio of 65 and an expense ratio of 30. You sum those, you get 95% of a combined ratio. If dividends are 2%, you can add that to the 95% to get up to 97%, and then subtract out the investment income of 2%. to get an operating ratio of 95%. How about moral hazard? So remember I said this in that learning objective slide. Moral hazard and adverse selection. These are really, really important concepts here. This describes the risk that once an individual signs up for a contract, they will behave differently than they would without the insurance. Now, you guys know that I like to give sports analogies. Sometimes I like to give comedy analogies as well. Do you remember the Seinfeld episode where Jerry was having an argument with the auto rental agency, and they're having a conversation about she didn't have a car for Jerry, and they went back and forth. It was quite funny. And so they finally decided on a car, and she said, "Would you like to have the insurance?" And Jerry says, "Yes, because I'm going to beat this car up." That's the moral hazard there. So Jerry had an incentive to take risks than otherwise would not dare take. So moral hazard increases the expected payout of the insurer. So how do insurance companies, try to manage this kind of risk? They use deductibles, they use co-insurance, and then there are policy limits as well. How about adverse selection? I first learned of this concept back in my graduate school days, when I was taught the concept that, boy, if you show up at the New York Stock Exchange and you're not very smart, you're probably going to trade with somebody who's smarter than you are, and you are always going to lose. So adverse selection is the risk that a company may attract bad risks more than it attracts good risk. And the problem here is that if it sells the product at the same price to everyone, it might inadvertently attract more of the bad risks. Adverse selection increases the chances of claims, overwhelming the insurer. And of course, this can lead to financial stress. So the best way to manage this adverse selection risk, look back here under moral hazard. These are parts. The way that insurance companies do this is they put these terms inside of the contract. But here, for adverse selection, they try to gather as much information as possible. Like, hey, if you want to have some life insurance, will you agree to some kind of a health exam? And so they come in and they take your blood and they make you do a bunch of stuff, and then they test it for things like alcohol and tobacco and drugs, and of course they take your blood pressure, and they do all sorts of stuff to gather as much information as possible. How about the difference between mortality and longevity risk? All right, mortality risk, the risk that wars and a host of diseases will increase the rate of death. And so if people are dying sooner and quicker and in greater numbers, more deaths than initially anticipated, then this is, of course, going to negatively impact the insurance company's profitability because it's going to have more payouts. Now, on the other hand, increased mortality risk increases the profitability of those annuity contracts because they don't have to pay it after someone dies. Now, on the other hand, longevity risk is the risk that a person will live longer than initially expected, thanks to advancements in technology and in lifestyles and medical science. Now, increased longevity risk adversely affects annuity contracts because the sponsor ends up parting with more of those payments. Now, increased longevity will improve the profitability of life insurance contracts because those payments are deferred, and the insurance company will be able to collect more premiums. So how do insurance companies hedge this stuff? Careful pricing and reinsurance. Of course, reinsurance is a big business where, insurance company gets all these premiums, and then they look at their pool and they might say, you know what, I don't like these people over here. I don't like these people over here. Let me put this off to a third party. So that's a risk transfer, but it can also be hedged with these longevity derivatives. There are really so many cool derivative contracts out there. One of these is a longevity bond, where you look at an entire population of people, and what you do is you can sign this contract, this derivative, And what happens if this more and more people are living longer and longer, then this longevity bond will make coupon payments to the insurance company and higher coupon payments over time to offset that risk. How about main risks facing insurance companies? All right, so the main risk is that on any given day, there are going to be lots and lots of people who die and who get sick and who crash their car and whose houses burn down. All right, so what insurance companies do, they set aside some reserves. So this big risk then is that these reserves are not sufficient enough to cover all of those claims. And so the actuaries, they tend to be fairly conservative when calculating the reserves needed. And so there's a big battle there between, do we need all this money in reserve, or why can't I go out and invest it on the floor of the New York Stock Exchange so I can turn 10 into 12 or 15? Now, of course, increases in default rates is no good for insurance. This risk can be mitigated by diversifying investments over a range of industries, a range of sectors throughout the economy. Financial institutions all across the board are faced with liquidity risk because if they're investing in stocks on the floor of the New York Stock Exchange, they could probably sell those things. But if they're investing in, stocks that don't have lots of trading volume or bonds that might never trade, there can be significant liquidity risk. And of course, there's credit risk. There's credit risk wherever you go. Let's go ahead and wrap this up by switching over to defined benefit and defined contribution plans. So in a defined benefit plan, so this is exactly what the name suggests, the amount paid to the employee at retirement is specified by the plan, a defined benefit. Now, what the employer typically does then is hire a sponsor to manage this pension fund. And what the sponsor then does is go out and take some of this capital and invest it in stocks and bonds so that when employees retire, there's enough capital gains and dividend income to be able to make those payments. Now, the benefit payable is almost always a function of a formula. It depends on the number of years the employee has worked and their final salary. And typically what happens is they take the average of the last 3 years of salary, multiplied by the number of years that are worked. Now, the unique part of the defined benefit plan is that the employer bears all of the investment risk. Remember, the employer can set aside a certain amount of capital every week or every month or every year, and then the pension fund manager could take that money and take it to Las Vegas and bet it all on the black and then bet it all on the red. And all of a sudden that thing could be worth billions of dollars if it comes up the correct color every single time, or it could come up the wrong color every single time. And then there's no money in that. So then the employer then has to fund that out of profitability sometime in the future. Now, of course, what happens is all these contributions go into a pool, and then the payments to the retirees are made from that pool. But remember that it's the employer that bears all of the investment risk, which is just the opposite in a defined contribution plan, which is what I have. My employer puts a certain percentage of my salary in every 2 weeks or twice a month, and then I do the same kind of a thing. And then I get to tell where I want these contributions invested. And of course, I have invested in a well-diversified global stock portfolio. And when I retire, and I think I've said this to you guys before, is that since I have these 14-year-old boys, I'm never going to retire. But in the event that somehow they graduate from college and get jobs, then maybe I can think about retiring. But clearly the amount that I'm going to generate during my retirement years depends on how successful these investments have been performing over the course of my working life. And that takes us through Chapter 2. Next up, mutual funds and hedge funds.